Welcome back to QAV, Tony. Episode 811. Dummy portfolio was up 3% in the last week versus the benchmark, which was down 0.18%. We're still 12% per annum up for the financial year versus 5% for the benchmark. So vis-a-vis the benchmark, we're doing quite well this year so far.
Yeah.
The US portfolio also recovered this week. It's up 38% for the financial year versus, wait for it, the S&P 500 up 3.6%
USA,
for the financial
USA.
year.
Slightly better than inflation.
10 we're doing 10 times better than the S&P 500 over there with no Mag 7 stocks.
Probably why.
Obviously.
Yeah.
It's just bonkers. Absolutely bonkers.
Mm-hmm.
But there's been some winners and losers this week, which we can get into. What do you want to start off with, Tony, in your list of talking points?
Yeah, well, I think one of the winners/losers, probably more of a loser this week, has been Ramelius Resources. And I know that's also a question from one of our listeners, so I may as well cover it all off now. I'm scratching my head at this one. When I did my results roundup on Ramelius, I thought it was a good result. And I'll read from Stock Doctor's summary. Okay, so this is from the 5th of March. Stock Doctor said that they're initiating coverage of the gold producer Ramelius Resources as a star growth stock following analysis of its half-year result and operational risks. We did a pulled pork on Ramelius about 12 months ago, so people can go and listen to that. I was thinking about doing it again, but I'll cover off most of the recent issues today anyway. Their big operation is in WA. Mount Magnet and Edna May are two of their mines, among others. They've also been on the acquisition trail over the year, and Stock Doctor report that they bought Spectrum Metals and Apollo Consolidated in recent years. Their performance was good for the first half of 25, revenue surging 46%, driven by higher production and rising gold prices. Net profit after tax soared 313% to $170 million, reflecting a robust 61% cash operating margin. The company achieved an average gold sale price of $3,541 per ounce, that's Australian dollars, well above its all-in sustaining costs, AISC, of 1,699 AUD per ounce. Their return on invested capital was 44%. And Stock Doctor said, with solid free cash flow, a low hedge book, and a conservative balance sheet, Ramelius is well positioned to take advantage of the strong gold prices. It also holds a strategic investment in Spartan Resources, a growing gold explorer. So, tick, 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 tick. The only question I had about the results was $16.99 for its costs, AISC costs, is getting up towards the high end of the range. But when the gold prices are we're just about double that, it's still a healthy margin. So roll forward a week, and Ramelius came out with its plan, or its long-term plan, for its flagship Mount Magnet mine. And Stock Doctor again put out an update because that Ramelius announcement was not good. Ramelius's latest plan for its flagship Mount Magnet mine was weaker than expected, with annual gold production now projected at 140,000 ounces, significantly lower than the previous estimates of 173 to 182,000 ounces. However, the mine's lifespan has been extended by 10 years to 2044. The company is investing heavily in expansion, with total capital costs nearly doubling to $823 million, well above market expectations. Also, a $95 million mill expansion will increase processing capacity, but long-term throughput is expected to decline due to harder ore. Maintaining full capacity would require further costly upgrades. To manage financial risk, Ramelius has put price protection measures in place, securing a hedge for 22,500 ounces of gold in 2027. This helps offset the impact of rising costs and lower early-stage production. We anticipate negative earnings revisions to flow through following this update, and placed the stock under review as reassessed changes to its outlook. So that's a week after the results announcements come out. It's possible that they took the following week to finalise their numbers on their long-term plan for Mount Magnet. It's also possible they knew damn well what was going to happen, and could have announced the Mount Magnet review at the same time as their annual results. But anyway, a week after Stock Doctor praised them and made them a star growth stock, they put them under review. The share price tanked. I think at the time of the announcement, it was around $2.70. It dropped back to around $2.20. And then yesterday, we get the news that Ramelius has made an offer to acquire Spartan Resources, the company it owns 19% of now. So that summary is Ramelius Resources plans to acquire Spartan Resources in a $2.4 billion deal to create a larger, more attractive gold producer. Spartan shareholders will receive 0.25 cents in cash and 0.6957 Ramelius shares per Spartan share, valuing Spartan at $1.78 per share and 11% premium. The merger comes as gold prices hit record highs above $3,000 per ounce. The combined company will be worth $4.2 billion, targeting 500,000 ounces of annual gold production by FY 2030. They go on to say Spartan's board supports the deal. Ramelius aims to boost Mount Magnet's output and margins by acquiring Spartan's high-grade Dalgaranga gold project, while also achieving cost savings by eliminating duplicate expenses. So in other words, the timeline is release good results, share price goes up. Release bad forecast for Mount Magnet mine production, share price goes down. Release plans to acquire Spartan Resources to replace Mount Magnet lost production. Share price has gone down 2 cents, probably because of the costs that Ramelius will incur in doing the acquisition. But all of those three things require a fair bit of planning, and they should have all been announced fairly close to each other, closer than within 2 weeks of each other.
So just looking at, I've got the chart open, it was actually at $2.80 on the 10th of March. It dropped down to $2.09 on the 12th of March. So that's a big drop. It's actually up to $2.20 today, so it's recovered a bit since then, but that was a massive drop.
Yeah, so this is either a lot of moving parts happening all at once, and the board couldn't get itself organised to do anything quicker than what it did, or it's a breach of disclosure, continuous disclosure rules, and it'd be a hard one to prove, given that everything's happened within a couple of weeks. The board would say it needed the time to prepare to announce things properly. But it just seems ham-fisted at best, and a problem with disclosure at worst. So I've been thinking, that I'm more inclined these days to say we can't rely on ASIC or the ASX to enforce continuous disclosure. So maybe we need to start red flagging these companies that aren't giving us good disclosure and just refuse to deal with them. And so it's a hard one. I mean, if only we had a regulator who could tell us whether this was a breach of continuous disclosure or not, it'd make it easier. But I mean, we saw results that are a surprise on the downside from Fortescue, from Bendigo Bank, from Ramelius's results were good, but then their plan for Mount Magnet was bad, and then they've patched that with the announcement of the acquisition of Spartan. So. Yeah, it's a hard one. I'm thinking about slapping a red flag on this company to improve its disclosure, until they improve their disclosure.
Well, a couple of things on that. Number one, I had a chat with Chairman Mab this week, and I know you have been chatting with him as well about this, Chairman of the Australian Shareholders Association for new listeners. He's coming on the show next week to talk about this. He's been doing his investigations as part of his role at the ASA. Is going to come in and share what they've discovered, what their conclusion is. Secondly, I want to just disclose that I own 2 parcels of RMS in my super fund and a couple in the light portfolios as well. One one parcel of my super fund I bought back in March of 23. I've held it for 2 years. It's up 97%. But the second parcel I bought February 25 and it's down 12%. The light parcels are down 9% and 17% respectively. And the third question, if you're talking about red flagging this, would that be a red flag don't buy it or a red flag sell it? What kind of
Yeah, it's a good
level
question,
red
isn't it?
flag? Are we talking a red flag? Do we have a
Mm,
double red flag status? Because we sudden CEO or CFO resignation is a
so,
immediate sell
correct.
red flag. A qualified audit is a don't buy red flag.
Hmm.
Um, if is qualified audit a sell red flag? I don't know if we've ever had that arise.
Yeah, we have. Yeah, it was a sell. I think Apollo Tourism and
Is it
Leisure
sell?
had a qualified audit when it was in one of our portfolios.
That was a long time ago.
Yeah.
As long-term listeners will know, my nemesis, Apollo Tourism. So yeah, what do you think about non-disclosure?
It's a good question, isn't it? It'd be a red flag don't buy for me, I think, rather than a sell, because the sentiment's still holding up. And look, I'm not even sure about red flagging Ramelius because, like I said, these things have happened sequentially, and the board could perhaps argue that you can't just do everything at once. It would there was a bit of planning and preparation required to get the information
I
out
mean, the
there in
acquisition of
detail.
Spartan, the acquisition of Spartan, I can buy, but the performance of the Mount Magnet mine, surely they knew that when the results came out. They should have known
Yeah.
that. That's part of
Yep.
preparing your results, right? Is
Yep.
if you're a mining company, is getting your mine managers to tell you what they think the outlook is for the next year, 2 years, 5 years, and that's the whole point of a report is to
Hmm.
report on how your business is going. Well, you can't put out a report and say, well, we couldn't report on how the business is going when we put out a report because had we couldn't get our ducks lined up in time. Like that's your job. You have one job.
Yeah. Look,
Report on how your business is going.
I'm not going to disagree with you. Um, I'm kind of reluctant to put a red flag on Ramelius. As you said, it's been on the buy list for a long time, on and off anyway. I've owned them in the past. I've been happy to own them in the past. They've done well for me in the past. The gold price is flying. I can't see much that's going to bring the gold price down, given the vacillations that are going on in the US and the heightened volatility in the stock market. So, yeah, I think you're right. I think it's not a red flag don't buy. But it's probably a red flag don't. It's not a red flag sell, but I think it's a red flag don't buy. Um,
Right. So
so
are we going to add a column
is
to
that
the
an
checklist now?
I don't know. I haven't really thought through this at all. I just got pretty upset with the announcement yesterday. It almost, to me, it smacked like they were patching up their mistakes from last week when they announced the Mount Magnet mine wasn't going to do as well as first thought, was going to cost more. So they've gone, what can we do about that? Oh, we own 19% of the next door mine. Let's launch a takeover to plug the gap. Um,
So is
that's
a
what it smells
continuous
like.
disclosure is a continuous disclosure red flag different to a confession season failure flag, or are they the same flag
I don't know. Why don't we just
in
think
theory?
about it for another week or something? But they're all good
Well, I've got
questions.
a question later on about the last time you said you needed to think about it, which was, do we really need the original byline if we have the second byline? I think it was like 18 months ago, the last time you said, I just need to think about it a bit. So we'll get to that later on.
Oh, will we? Okay.
I'm not so sure about
I'll
this.
think
I need to
about it.
think about it a bit thing because they.
Well, you're asking good questions, and I don't have an answer for them. So all I can do is think about it. All I've got in my notes is I'm thinking
Okay.
about putting a red flag out there for continuous disclosure. Um,
Yeah, I think I think we've been, we've seen a number, there's too many of these things
yeah.
recently. This is really a disturbing trend. In all of my years of investing experience, Tony, 5 of them, whatever it is. I'm shocked that there is gambling going on in this establishment. It just seems there's something in the water. There's
Yeah.
like some word has gone around. We don't need to do that anymore.
I think you're right. I think because in my 25 years plus of investing, I don't think I've ever heard of anyone pinged for breaching continuous disclosure. There's certainly been some class actions which have uncovered it, and that's the disgrace that goes on with our share market. It's a regulated market, but it takes class actions by lawyers to point out lack of continuous disclosure. Not that there's been a whole heap of those, but there's certainly been some, but not a lot. And I think you're right. Directors are just saying whether they're overworked, whether there's too much red tape, they're just going, continuous disclosure, forget about it. No one's ever been pinged, and they're not doing it.
Mm, mm, mm. Or they get a slap on the wrist or a tisk tisk and a finger
Yeah.
waved at them, and
And I'm also not sure that if we put a red flag on a company for a breach of continuous disclosure, that solves the problem, because they're the company that's probably learnt their lesson. And it's going to be somebody else who does it next time. So um, that's why I think I've got
how
to
have
think
they learnt
further.
their lesson?
Oh, well, the share price has tanked after they surprised the market. I mean, that's one thing that will be ingrained in the memory of boards is, hey, CEO, last time you did this, share price dropped from $2.80 to $2.08. Don't do it again.
So, which makes me ask the question, why not disclose during confession season,
You
whatever it
should.
is? I mean, if you don't disclose because you're worried the share price is going to take a hit, then you finally come out with it and the share price takes a hit.
It's
It's
worse.
not like you're the government releasing bad economic figures at 5 o'clock on a Friday and you hope you're going to get through the weekend media cycle and everyone will have forgotten about it. You hope Donald Trump does something over the weekend to take everyone's mind off it by Monday. I mean, the if you're a decent sized company, analysts are going to see this, the market's going to react to it. You're not going to get away with it unless you're a very small company that doesn't have a lot of coverage. So I don't understand what the thinking or the incentive behind not disclosing would be. I can't make the algorithm work here.
Oh, I think it's at best some kind of bad gamesmanship. If we put out good results first, then we announce bad news, then we announce an acquisition to replace the bad news. Maybe they think they'll get away with it. Would be one
But that's
strategy
this
I can
particular
attribute to them.
instance. I'm
I don't
talking
know if
about,
that's the case in this case.
but I'm talking about all of the companies we
Yeah.
saw
Well, they're scared.
sort of just skip confession season.
They're scared. Either they think they're going to get away
Of
with it,
what?
or they're scared that when they do
How did
announce the bad results, they're going to take a hit. But it's like Buffett says. All he wants from his managers are, if you have good news, write me a letter. If you have bad news, pick up the phone. You've got to get in front of bad news. Just get it out there. You know, confess, as Buffett does in his first line of every annual report. I stuffed up this year, and here's how. Just get it out there.
Yeah.
It's because
Yeah, you
CEOs are
love that.
salespeople. They don't want to announce bad news.
But again, as you said, like it comes out eventually.
Yep.
The share price takes a hit. So
Yeah.
I just don't. I mean, like I don't know. I've never been a CEO of a publicly listed company, so I don't know what's involved. But it just seems like it's a no. There's no upside for
No.
them that I can see apart from kicking the can down the road by a couple of weeks or a couple of months.
Yeah. Yeah. Look, I think Ramelius kind of shot itself in the foot. No one was asking for a 10-year update on Mount Magnet mine expansion. It's a bit like you don't hold a royal commission until you know what the answer's going to be. It's like, um, why did they even announce a 10-year update to Mount Magnet if it was going to be bad news? Like, just don't finish the report, put it in the bottom drawer and bring it out when the news gets better, or when you've got an update that will be thought of kindlier by the market.
So now you're saying they shouldn't have disclosed that.
They had to once they knew. All right.
Yes.
But that's
Yeah,
what I
once
mean. This
they
is
knew.
almost idiotic. Like they spent all that time putting it together, which means they have to disclose it.
Yeah.
At some stage during the process,
Yeah.
someone would have said halfway through, check this spreadsheet. Not looking good, boss. And the boss should have gone,
Yeah.
yeah, go and do some more numbers, and I'll think about it.
Should have gone la
I'll
la la
think
la la
about
la
it.
la 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 la.
Let
Yeah,
me
I'm
think
thinking
about that.
about it. Yeah. Yeah. All right.
Hmm.
Moving right along. What else you got?
Okay. Ah, yes, Shape Australia. So I was finding it hard in the using the buy list today to work out a stock that was still going up, given all the general malaise in the market over the last week or so. But Shape Australia has been going up strongly recently. It's new on the buy list this week, so I thought I'd do it as a pulled pork, even though it's not a big stock. Its ADT is probably only going to suit small portfolio investors. Its ADT is 114,000, so I'll call that out at the start. New on the buy list this week, Shape Australia is a construction, fit out, and refurbisher of commercial properties. So it's been around for a long time, and it basically does fit outs, but it's just branching out now into builds as well. From their website, they say that they are a nationwide ASX listed fit out and construction services business with a team of more than 645 people working across all capital cities and a number of large regional centres. We've delivered more than 7,250 projects valued at $10 billion over the 35 plus years we have been in business, with a focus on innovation, safety, and building trusting relationships. Our clients span the commercial, education, government, retail, and health sectors. While our origins in commercial fit-out have created a strong foundation for the business, our $3.2 billion pipeline for FY25 spans fit-out and refurbishment to facade restoration, design and construction, new builds, and modular projects. So that's basically what they do, and a bit of their history. They have an association with a company which looks like some kind of joint venture called DLG Shape. And I wasn't able to find the exact nature of the relationship without digging too much deeper than what I did. But DLG Shape is some kind of joint venture with an Aboriginal focus company, which is in partnership with the David Lydiard Group. So David Lydiard is an Aboriginal business person who's done a lot of work in getting Aboriginals to own, run, and be employed in businesses. And Shape have worked with them to create a part of their business to foster those career paths and ownership and employment opportunities for our Indigenous nation. DLG Shape had nearly $100 million in revenue for the year, so it's been somewhat of a success for them. Latest results are good. Revenue's up 15.4%. Profit after tax is up 25.6%. And they went ex-dividend a little while ago, but the dividend has now been paid on the 10th of March, which was 10 cents. So we can use the bread later without making an adjustment for them. They called out in their results that they've undertaken 2 expansion strategies in the last 12 months. They have actually 3. They've moved away from the commercial sector or the office sector, and they have won contracts in hotels, education, health, retail, and defence. And they've also expanded geographically and won tenders on the Gold Coast, Newcastle, and Tasmania. And so they're now branching out and putting some offices in those locations as well. They also launched 2 new divisions last year, which are growing okay. One's called the Aftercare and Facilities Management Division, which looks at maintenance of work that they've done in the past. And they've also now have a design and build business, which is, as it says, designing new construction. They did also call out that part of their business is starting to slow, which is called the facade remediation work, which is to do with replacing the cladding on buildings that wasn't fire resistant enough. So that's sort of coming to its end naturally. But the revenue was still at 15%, even though that part of the business was slowing down. One other thing to notice is that Shape Australia, even though it's a small cap company, has is just about to be added to the All Ordinaries Index on the 24th of March. So that announcement came out a little while ago, and I think that's part of the reason for the share price increase as fund managers try and get the bump from inclusion in the index. And I suspect on the 24th of March the bump will continue as fund managers who back that index include it in their portfolios. So I think in the short term the share price will be underpinned at least. Going to the numbers, the price I used for this analysis was $2.96. It's 17% lower than consensus share price, so that's good. But it's above IV1 and IV2. IV1's $1.08, IV2's $2.22, so we can't buy it from that perspective. The yield is strong in this company, 6.35%, and just above our hurdle of 6.12%. NEPS is only 40 cents per share, so we can't buy this one for book value. Stock Doctor Financial Health and Trend is satisfactory and recovering, and we score it a 2 for recovering. Stockopedia give Shape a quality ranking of 94, which is good, and an F score of 7 out of 9, which is very good. Stockopedia have an overall rating for Shape of 99 in their ranking, which is out of 100, so that's excellent. We don't score for ROE, but I did notice that ROE was 58% for this company, so that's pretty good, pretty profitable. PE is 14 times, which is neither highest or lowest in the last 3 years, so we don't score it for that. But prop cap is only 5.5 times, so that's one of the reasons why it's on our buy list for from a value perspective. Forecast earnings per share growth is only 6%, so we can't score it for that. Directors hold 5%, so we're not going to score it for owner-founder. However, I did a bit of digging, and the original founders still hold approximately 30 to 40% of the shares. So there's still a significant amount of owner-founder ownership of the company, even though they're not sitting on the board. One of the founders, Stephen McDonald, passed away recently, so that may affect that number. But the other founders remaining who hold shares are Jared McMahon, Daryl Drayton, and Mike Van Leeuwen. And as I said, they still own between 30 and 40%. Lastly, SHA is growing its equity consistently, which is a nice thing to see. So overall, quality for this company is a score of 10 out of 15 or 67%, and the QAV score is 0.12. So towards the bottom of the buy list, but new on the buy list this week, and the share price has been going up, so something to have a look at. Strengths, they're at pains on their website to talk about their people culture, and sometimes that can be just lip service, but it does seem to be part of their culture, so it'll be a strength. And it's also potentially shaping their involvement with DLG Shape, their Aboriginal business. I think it's good that they're growing the business away from office fit-outs, but and that would have been a good thing to do when work from home was in its starting its trend or happening in droves. But that seems to be reversing a bit now, with more and more companies mandating returns to the office. So that may drive that business again for office fit-outs to accommodate people returning. So that might reverse. I think the risk for a company like this, like any builder, it's cost blowouts, and they've been managing their costs well according to their results. So their margin remains strong, even though obviously wages costs have been going up and product costs have been going up. But cost blowouts are always a risk for this kind of company, as is tendering risk. So, getting caught with the wrong kind of contract when costs go up. So mitigating those two things, though, are the fact it's been around for 35 years, and the management's very experienced through a number of cycles like this, so they should be able to, they're showing that they can manage those risks. So, that's SHA, interesting company I hadn't heard of before.
Thank you, Tony. They have been on the buy list before this week at some stage, because I've had them in the light portfolio for a while.
Okay.
But not that long. So I think they turned up a few weeks ago or something, yeah. But dropped out and then came back in because, let me see, when did I add them? 5th of March. Oh, so only 2 weeks ago, right. So they're up 1%, killing it since then. Good job, SHA. Keep it up. All right. Well, that is that for this week. Anywho. All right. I know you got to go. I got to go. Have a great week. Thank you, TK. Have a good week, everyone. And we'll be back next time with more. See whether or not Trump crashes the
More
market the
thinking.
next week.
Yep.
Yeah,
Yeah.
yeah. You think. You
I'll
go
think.
think.
Mm.
All right.
We'll have
Thanks.
Chairman Mab to
Cheers.
quiz about it next week too. Yep.
Oh, we will. Yeah, I'm sure he'll be thinking about that
Mm.
between now and then.
Yep. Have a good week.